All right, we're back. Tasty Crypto Show. I'm Dan Cecilia, and today in studio we got a very special guest, Greg Magadini, professional options trader and head of derivatives at Amber Data. He's a regular on the show, and always great to have you and share the insights. So thanks for joining us in studio. How's it going?
Yeah, thanks so much, Dan. Yeah. I mean, the studio is pretty nice. I can't lie. This is amazing. So happy to be here in Chicago. Fun experience. Happy to talk to you. Got plenty of stuff to talk about. So let's dig into it.
Yeah, for sure. And I appreciate the kind words about the studio. I think it's the coolest part of the entire thing. So most of our guests, when they come in, they're like, "Yeah, studio's sick." So yeah. You're totally right. But you know, we follow your newsletter a lot. Whenever we have you on, we kind of go through and kind of just break down your thoughts. So let's just jump into it from last week. We had this Fed update and like an interesting market reaction because it was the cuts were priced in, but market reacted strangely. So can you just kind of give us an overview of what happened there? Yeah.
So just to contextualize where we are. So last year we cut 50 basis points. Inflation was actually lower last year than it is now when we're cutting. So that's kind of an interesting context, but just to kind of talk through the market reaction. So risk assets really rallied into sort of this FOMC rate decision. And really how the way I interpret that is that the market was pricing in cuts and future cuts. And so the initial reaction when the Fed cut 25 basis points was really around the guidance that we saw in the economic projections of 2 more cuts throughout the end of the year. So we can see the dot plot here on the screen. And so that was initially bullish because not only do you get the cut, but they're kind of hinting that they're going to cut twice more. And then later in Powell's speech, he mentioned that a 50 basis point cut last week was completely off the table. So then that flipped from dovish to hawkish. So risk assets kind of had one of those big spike days. And then to top it off, Fed Powell essentially said, you know, he has no idea where inflation will be in 3 years. So he's been data dependent, really slow to move this whole time, really wants to see how job numbers come in, how inflation data comes in. So we kind of got more of the same. That's how I interpret it. And so I think a lot of traders had to like adjust their positioning throughout the day. And we got sort of this kind of big spike candle reaction.
Gotcha. Yeah. So if we look at the dot plot here, and then even this Fed Watch tool, you got an 80% probability for target rate of 350 to 375 bips. You said that Powell's speech noted 50 basis point cut was completely taken off the table, so struck the markets as hawkish. We sort of had a sell-off in Bitcoin, I guess, or risk assets, sort of a little bit of a sell-off, and then gold reacted, right? So there's been this divergence that we've been following between gold and Bitcoin. Do you think that Fed rate decision kind of made that gold rally, and sort of what do you make of that divergence between gold and Bitcoin?
Yeah, so I think gold is the classic fiat hedge. So I mean, gold is the money of 2,000 years plus, or whatever, 5,000 years, whatever the number is. Gold's tried and true, and we know that central banks buy gold and essentially have gold reserves. We know that the U.S. dollar has been world reserve currency. Everyone owns U.S. treasuries, but if you are in this inflationary environment, do you really want to hold treasury paper? And if you don't want to hold treasury paper, what other paper are you going to hold? I mean, if we look at the rest of the world, most of the Western world actually has lower rates and has inflation as well. So that's a lot less attractive than U.S. paper. So you're kind of stuck buying gold, and as we know, crypto to some people still seems kind of like a gambling asset, or like an asset that hasn't been untested and unproved. I kind of think the U.S. is leading the way in that narrative shift. So I think probably the first one to buy Bitcoin reserves would be kind of a U.S. country. So I think that's what's happening right now. Central banks and traditional players are buying gold as a dollar hedge.
Yeah. And I want to talk a little bit about the point you make about the Fed here. You think that you kind of get into this idea that Fed's a bit worried about jobs versus inflation. They're going to monitor both. Yep. But you think that the biggest driver of asset prices, particularly gold and Bitcoin, is Fed's independence. So, we have a new chair in 2026. Do you do you have any comments on that? Like, do you think Fed's independence is in question, and maybe that gives us a rise in risk assets? Or
I think that's the biggest risk for sort of asset inflation.
Okay.
So, the way we see it right now, there's a lot of pressure on Powell to hurry up and cut rates. He's like being cautious, still data dependent. He says, I've tilted towards jobs being my number one concern, but, we still trust him to care about inflation. Well, if inflation starts running hot, we got PCE this Friday, which is the inflation target number. That's what the Fed looks at, core PCE. If that comes in hot for whatever reason, and we know next year that Chairman Powell is going to be replaced, does the market really have the confidence that the Fed is going to be willing to fight inflation like it has been? I think the market's saying no. That's kind of how I'm interpreting this. And so what do you go into in terms of inflation hedging? And so I think that's why we're seeing this kind of gold rally. I think that is the biggest right tail risk.
Gotcha. Okay. And so we'll have to look to Friday to see how that PCA data comes out. Now, just so I have it correct, you think with this the Fed independence in question, maybe what happens in 2026 with the Fed chair, you think it will give a boost to risk assets if we do kind of get this, I guess, Fed independence, basically the Fed is not independent anymore and won't do what it needs to do to kind of support the dual mandate? Or you think it will give a rise to Bitcoin assets, risk assets?
I think if there's essentially a stagflationary environment or a runaway inflationary environment, 1970s is what I would look at as the sort of the template. And that was an environment when gold went from $35 to $700 in 10 years. So I think that's sort of the base case scenario I'm looking at. Now, in terms of Fed independence, where am I looking at for sort of that trigger? Long-term treasury debt. Long-term yields, in my mind, are kind of the story to tell. We're seeing this in Japan right now. So Japan 30-year yields are spiking in a fashion that they haven't in decades. And to me, it's like, let's not forget, Japan invented QE. Japan had its own real estate bubble. They're like 20 years ahead of us. So theirs was in 86, ours in 2008. And they're the ones who essentially invented QE and squished down rates to zero, and we're stuck in this deflationary environment and have the highest debt to GDP ratio. So they're sort of the canary in the gold mine of the quote-unquote debt supercycle. That's how I view it in my mental model. So they're the country that I look to the most. And then for the U.S., long-term rates are sort of what I'm monitoring in terms of Fed independence coming into question.
Gotcha. Okay. Interesting. So something we'll have to take a look at and keep in mind. I think, like you said, Japan is kind of the leading indicator there. I think bond yields did bond yields spike? The long end of the bond yields did spike after this cut.
Yeah, exactly. Yeah. They also had one of those like kind of wick hours. Yeah. But then now, bonds are cheaper, yields are higher.
Gotcha. Okay. So maybe some signal there that, could something be on the horizon. So let's get into some trades.
Yeah.
Because this is, I think, was the most interesting part of the newsletter was how you would position yourself here. So the trade that we've been covering and you've been saying looks sort of interesting is this 180-day 25 delta risk reversal.
Yes.
Can you get into that a little bit and just, what's your reasoning for that?
Yeah, so there's kind of two things I'm looking at in crypto vol. So the first thing is outright at the money vol for Bitcoin. So this is this first chart I'm looking at right now. 180 days is looking like 41 vol. We've been as high as 120 vol on 180 days. 41 vol is kind of the lowest we've seen in the past 6 years. Now, something I like to keep in mind is that when vol is low, everyone expects it to mean revert. So it usually trades at a premium to realized. So vol can remain lower, as I said, and you can remain solvent, so to speak. So just buying outright vol is never the most interesting thing to me. And that's where the risk reversal comes in. Because with the risk reversal, you're selling a put, a 25 delta put, in order to buy a 25 delta call. So now you're kind of vol neutral. And if things really kind of explode higher, which is sort of that right tail Fed independence trade, well, not only do you own the call that's giving you the delta exposure, but now you're going to be in a situation where vol is exploding higher as you own the right tail. And so that's kind of a double winner on that sense. And then you finance that by selling that put. So a 25 delta put is kind of like, I don't know, $56 on IBIT, which translates to about $100,000 Bitcoin price. So you're essentially standing on the line and saying, I'm willing to buy $100,000 Bitcoin. In exchange for that, I'm going to get the premium that I'm going to buy the 25 delta call. And so now you kind of have this big break-even window. Worst case scenario, you buy $100,000 Bitcoin. For a lot of people, I think that is an attractive level. And then on the flip side, if things go haywire to the upside, you have that exposure captured. And looking at that risk reversal chart here, we can see this is the first time in quite a few years that we're below the zero line, meaning the put is more expensive than the call. I think there's a few reasons for that, and we can get into that. But it's rarely here, for the exception of sort of the FTX blow-up time frame.
Right. Okay, so let's kick it over to the platform real quick, because I do want to demonstrate kind of how we can construct this trade using IBIT. So I'm looking at IBIT. Obviously, the market's closed. We could do I think we can do an extended hour order, but just do it. We'll do a demo for now. But basically, we're looking at the IBIT ETF. We're going to go out to the March 20th, 2026 expiration, 180 days. And we're going to look to buy the 80 strike, 80 or 85, because the 80 is the 32 delta, 85 is 26. So I guess we could buy the 85.
Yeah, I mean, it comes down. If you want to pony up a couple more bucks for the closer one, it ends up.
It might be better.
It might be better. Yeah.
All right. So let's buy the 80, and then let's go and finance that with the 50 delta, the 54 delta, 54 strike, 24 delta put. So we're going to sell that, and on the platform here, we're looking at it's about $5,500 to get into that position. We're looking at a 57 debit right now.
Yep. So you can play with those strikes a little bit if you want sort of to get away from the debit. If you're willing to pay the $50, you get, slightly better strike on the call side, slightly lower strike on the put side. You can kind of tweak that. It's not really going to change the nature of the trade.
Right.
And to your point, the fully cash secured is the 5,400 plus the 57.
Right. So, and really what we're looking at here is playing for that upside, playing for that Fed independence trade. So your max profit is, there's all upside there.
Yep.
And your max loss would be and essentially the credit, the debit you're paying. Is that it? Or the position?
You'll assume the position if we go below that 54.
Yeah.
But if you're willing to buy Bitcoin at 100,000, that's kind of a win as well.
Right. So it's kind of like a synthetic limit order, and
yes.
And that 100,000 strike is pretty attractive, or the 100,000 price is pretty attractive if you're bullish Bitcoin long term. You get it at a discount essentially, and then if it does spike to the upside, it's all profit there, right? So.
Yeah, exactly. And this is so like the way that we're structuring this trade, we're kind of like talking about it in like a long-term portfolio position. If you were really just truly trading it for vol, typically you would put this trade on with leverage and you wouldn't do cash secured and stuff like that. And what you'd be really looking at is, the spot vol correlation of Bitcoin. If the spot vol correlation of Bitcoin flips back towards a positive spot vol, so meaning when we rally with more volatility than when we sell off, that vol surface structure that we're seeing now would benefit a lot. And so that's historically how it's been. Lately, since IBIT launched options, we've kind of seen a consistent decline in that. And the reason why I think that is we have asset managers who buy equities. They typically sell covered calls, buy the put, which is the opposite of what we're doing.
Right.
As a risk asset hedge. And I think it's kind of the same investor base. We also got to keep in mind that Bitcoin doesn't pay a dividend. So the only way you get yield from it, if you're a long-term investor, sort of traditional investor, is by selling calls against it. So that's causing the call wing to flatten. And then we also have like covered call ETF strategies that are accumulating assets under management. So these are the people on the other side of our trade. And so it's important to kind of understand why is it priced this way to understand if it's really a good trade or if you're just kind of stepping in front of the train, so to speak.
Right. Okay. Yeah, it's great point. Something that I think a lot of retail traders, especially myself, because I'm, I would consider myself like a smaller retail trader, don't necessarily understand like why it vols, like why is vol like this? What is going on? What is the market structure for Bitcoin? And to your point, you lay it out great in the newsletter. It's these institutional investors are hedging, so they're selling the covered call and buying the put. The opposite of what we're doing here. That Bitcoin's non-yielding, similar to gold. So covered calls is a source of income, and then the ETFs, right? The growing AUM of the ETFs is sort of volatility dampening, in your opinion, right?
100%.
Okay.
Yes.
Yeah.
Yes. And those are the flows that we've been seeing. And to come back to gold real quick, because I do think gold's such an interesting parameter.
Yeah. Let's take a look at gold. Yeah.
Yeah. So when we look at the vol surface of gold,
Okay.
gold has a positive risk reversal. So the 25 delta call has a higher vol than a 25 delta put. So that's inverse to what we're seeing in Bitcoin. So that's divergence. Bitcoin is being priced as a risk-on asset from the vol surface perspective. Gold is being priced as sort of fiat hedge. But I don't think the whole story is Bitcoin is a risk asset. I do think Bitcoin is still a new kind of fiat hedge. And so I think gold's rally is a good sort of prelude to what we can see in Bitcoin.
Right. Okay. Yeah. And we're looking at the chart here, GLD, which is the ETF. I mean, look at that candle. It got up to 350. Got up to 350. On the month. And if we take a look at, and I just want to dig into gold a little bit because I do think it's interesting. If we take a look at the options chain, you think that there is there a trade here? Same kind of risk reversal trade you're saying, or? Yeah,
I don't think it's necessarily a trade I want to put on, but it's a trade to look at in terms of like comparing the pricing to Bitcoin.
Okay. Yeah. So is it the same type of thing, 25
delta, 180 days out, so same kind of expiration.
Okay.
And what you'll notice is that the call trades at a higher vol than the put. And the way that you want to calculate this is you want to go call implied volatility minus put implied volatility divided by at the money volatility. So you can normalize, because gold has about half the vol as Bitcoin. So you want to normalize how big is the differential in at the money terms.
Gotcha. And kind of the overarching sort of idea here is you're looking at the pricing.
Yes.
Between the two, because you think that they'll trade similar, right? Gold is the fiat hedge that people accept now. Bitcoin will be there. So it's kind of, you think it will catch up, or that's kind of what we're implying, is that it might catch up to be a fiat hedge. So there might, we're looking at the pricing essentially between the two trades. Okay.
Yep, that's what I think. I think, there's a good argument to be made. We were talking about this before the show, highly portable assets have a lot of value in sort of uncertain times.
Right.
And crypto is perfectly portable. I mean, you don't even need a hardware wallet. You can just remember 12 words in your head.
Right.
And go wherever you want.
Right.
I think if there's true sort of fiat panic, we'll see both gold and sort of Bitcoin hockey stick. But let's keep in mind that Bitcoin is 1/10 the market cap of gold, takes less money to move it around. So in my mind, those risk reversals should trade in similar fashion.
Gotcha. Okay. Yeah. I think it's an interesting note. I'm going to definitely, after the show, maybe tomorrow morning when the market opens, take a look at that IBIT one, because I got to admit, I've been following the trades and they've worked out well. I did the I did the MicroStrategy one, selling the call spread, financing some of the ETH upside. I need, we got a couple minutes left. I wanted to get through this risk reversal idea and kind of show everyone what we were looking at here. Anything else in your mind? It could be anything. Is there any trade, anything you're looking at? Doesn't even need to be crypto, just anything. ETH could be Sol. What do you, anything here?
Yeah, I think another theme that probably will keep coming up, as we keep chatting, I think the digital asset treasuries are going to be an interesting theme going forward. I read this book about the 1929 crash a few years back, and for anyone who hasn't read about the 1929 crash, in a 2-second version, people were buying stocks were doing well. People set up holding companies that would issue shares to buy stocks. So then you buy the holding company, kind of like an ETF to own portfolio. Then holding companies started borrowing debt to buy more stocks, and you get leveraged holding companies. And then you got holding companies of holding companies, and then you got leveraged holding companies of holding companies. And if we look at digital asset treasuries, we're kind of seeing that same type of play. First, you take the cash on your balance sheet and you put it into crypto. It's non-leverage. Then you raise debt to buy crypto. And at some point, we'll have ETFs of holding companies, and then we'll have leveraged ETFs of leveraged holding companies, so on and so forth. I think that's going to be a very interesting sector to pay attention to, especially as holding companies try to catch up and go further down sort of the risk asset tokens.
Yeah.
So it's one thing to own Bitcoin. It's another thing to own Ethereum. Then you start owning some random coin with small float. Then you leverage that random coin with small float, and any sort of pullback cascades. So that'll be an interesting theme to look at, keep in mind.
Yeah, I think that's a great point. I've been doing this for our weekly newsletter. I put together a watch list of all the crypto treasury companies I could find, and I'm including like Coinbase and Circle in there, just in Galaxy and even like Backed, and so just basically any type of crypto public company that has crypto on the balance sheet. So one that came up recently, obviously we've done MicroStrategy, covered that a bit. One that came up recently is this Forward Industries, which is the Solana one. So to your point, we're getting farther out in the risk curve here, because as a crypto native, we're looking at Solana and we're like, this is a great chain.
Right.
I'll hold the spot product.
Totally.
I don't need exposure through an ET or a crypto treasury company, but maybe some people want to trade that. So this Forward Industries is one. We obviously had Tom Lee's BitMine, which was the big trend in July with ETH running, and now I've heard we're getting even further out. So there's a couple for some yield-bearing stablecoin one. I think they've talked about Hyperliquid, which is like a perpetual future exchange token. I wrote about it in our newsletter. So we're getting there, to your point. And I think like what people don't necessarily understand is the way that these things can be structured, right? It's like raise money and go buy the spot asset, fine. But eventually they're going to start borrowing because maybe the price goes up or the NAV goes up and they can borrow against it, and kind of becomes this debt bubble essentially, and it'll unwind at some point is kind of the point you're trying to make. So don't get too far out on the risk curve, basically.
Yeah, and careful with leverage. We saw huge liquidations this week.
Yeah.
And the market barely moved. So let's keep that in mind.
Yeah, exactly. Yep. So, all right. Well, love having you on. I think it's always great to talk about some of this stuff. We'll keep monitoring all of this. And anything else around, like, where can people follow you and so maybe subscribe to the newsletter?
Yeah, absolutely. So you can check out our newsletter at amberdataderivative.substack.com. And you can check out our free platform where you can look at all the volatility profiles for crypto vol, including perpetuals and futures, the basis, leverage, open interest, liquidations, all that good stuff. pro.amberdataderivative.io.
Great. Well, that's all we have for today. I'm Dan with Greg in the studio. We'll see you next time. Peace.